So we're going to pick it back up today with the case of the Federal Reserve independence. Up until 1951, with what they call the Fed Treasury Accord, at that point the Fed had basically, it functioned to help the Treasury with their borrowing. So that's pretty much how they determined not monetary policy at that point. And the Treasury Secretary was always a voting member on the FOMC. They had a lot more power than the Treasury's had since then. Since 51, they've been independent. They've been able to implement monetary policy largely as they see fit, consistent with the goals that the Congress gives them. So the case for independence, which is how we ended class, the strongest argument for an independent central bank is the view that if they subjected to political pressures, force them to conform to what either Congress or the president wants, you would end up with a monetary policy with inflationary bias. There's been studies of central banks across the world, and central banks that are more independent from the government than ones that are more tied to the politicians' wishes, they tend to have lower inflation, a more stable price level. Which is unsurprising because when politicians, whether it's Congress or the president, whatever branch, they're more likely to have more of a short-term focus than the central bank and FOMC members. Obviously, politicians need to get reelected, so they would put more pressure on the Federal Reserve to lower interest rates. Lower interest rates will help lower unemployment, and inflation comes later. So forget about that. I give an example of Richard Nixon, who bullied and threatened the Federal Reserve chair before his reelection campaign to keep interest rates low and worry about the inflation later, because it wasn't going to happen until after he won reelection. Which again is ironic because of Watergate, he had to step down immediately afterwards. But there's also arguments to be made against independence of a central bank. People argue that it's undemocratic that these people who are unelected are able to have such a strong influence on the state of the economy. If politicians were doing a bad job at, suggesting monetary policy or putting pressure on the Fed for monetary policy, they were doing that poorly, then people could just vote those politicians out and vote in politicians that have better ideas for monetary policy. Whether that would work in practice is questionable, but that's the way the argument goes. It's the responsibility to know one which really concerns them. And things like the General Accounting Office does not audit the Federal Reserve like they do like every other government agency. So there's no way to see specifically, I don't really understand the whole audit the Fed thing besides just that it's a show, but they want to see exactly what the Fed's balance sheet is and what exactly they're doing. That's just a way for Congress to put pressure on the Federal Reserve. So like I said, political pressure would impart an inflationary bias to monetary policy. They would tend to have a more accommodative monetary policy. If you look at Trump right now, who's been putting pressure on the Fed to try to lower interest rates, some of it is because of government debt. They would lower interest rates on the national debt, or lower interest rates to make the national debt less difficult for the government to pay off. If the interest rates they're paying on government debt is 1%, that's a lot cheaper than if they have to pay 7-8% interest on it. Additionally, low unemployment for a re-election campaign is great. Voters tend to be myopic. In the lead up to an election, they're really concerned about economic performance in the 1 year leading up to it, or the 6 months leading up to it. That's how Reagan could have almost 3 years of recession during his first term, but a really good year before the election and win by such a landslide. There's also the political business cycle, which is basically Um, you have the central bank undergoing expansionary monetary policy in the lead up to an election. You see the unemployment rate fall, you see the inflation hold steady and then begin to rise after the election. At which point the unemployment rate begins to sneak back up. There's the idea of the natural rate of unemployment, where there's always going to be a certain level of unemployment in an economy because there are people that aren't qualified for jobs, that have training in jobs that are no longer required, or maybe they live in a different place than where jobs are being offered. So there's going to be some level, and there's always going to be some churn in the economy, people leaving jobs and then taking time to find a new one. So monetary policy isn't effective in the long term to get you below that natural rate of unemployment. If you do, you can go down below that for a short time, but you're just going to end up with inflation because firms have to, with that low of unemployment, have to offer more money to get people to leave their current job and take a new job, which will put upward pressure on prices, higher labor costs. And in the end, the unemployment rate ends up rising back up to the natural rate. So if it's 4% and you push it down to 3% for like 6 months or a year, it'll end up moving back up to 4%, but with higher inflation now. So what happens in the political business cycle is after the election, the central bank's then forced to tighten monetary policy. The unemployment rate increase again, the inflation rate fall. It's still going to be higher than it was before to start it. And then pretty soon, it's time for the next election. So they're cutting again, even if they don't need to cut interest rates in order to help the politicians get reelected. And the cycle goes over and over again. So you get slowly just increasing inflation over time. There's strong evidence of periods of political business cycles over like a couple election cycles in several different countries. The US back in the 70s was one of them. But we don't see it lasting very long. At a certain point when inflation gets out of hand, the central bank is forced to act against the politicians' wishes. Like I mentioned with Trump, a more accommodative monetary policy helps the Treasury finance their debt easier because there's lower borrowing costs. There's the idea that monetary policy is too important to be left to politicians. Politicians have a worse, what they call principal-agent problem, where the American citizens, everyone that lives in the United States, we are the principal. That we say, compare it to a publicly owned company where all the owners of the company's stock, they are considered the principal, that they're the ones that own the company. And then the agent is the CEO, the person that they hire to run the company. We can think of a country the same way, where all the citizens are the principal, and then the agent is the politicians that we elect to run the country for us. Because obviously you can't get 300 million people to reach all these different decisions together. However, the principal and the agent tend to have different desires and different goals. So where they don't overlap, we tend to have this principal-agent problem. When you argue for the independence of the central bank, basic argument is that the unelected people that we nominate to the Federal Reserve Board, that their incentives align more with as the principal, with the people that live in America than the politicians will. Because again, a big part of their goals is to get reelected, obviously. There's a few examples where the political business cycle, or not political, but where Fed independence made them take an unpopular, in the short-term, monetary policy in order to achieve a better outcome. The first example is Paul Volcker. He was nominated to the Federal Reserve by Jimmy Carter in the late 70s. At that point, inflation was running in the double digits. It was over 10%. So what he did was drastically change how Fed policy operated up to that point, and his goal was to what they called break inflation's back, was to literally drop it back down into like the low single digits. So the federal funds rate soared to close to 20%, which, I mean, it's like been 1-2% for the past couple of years. So it's extremely high. The economy went into a recession, obviously, with interest rates going that high. Carter lost his re-election campaign in large part because of the performance of the economy. Some of it being inflation, some of it being the recession. And then when Reagan took office, they continued the recession into his term for a while. Then there was a brief recovery and then another recession back to back, which were both due to the Fed's really high interest rates. People were so frustrated by it, home builders would send in little planks with a nail through it to both Reagan and to Paul Volcker, because people weren't buying houses because the interest rates were so high. So, I mean, your APR on a mortgage was through the roof back then. However, in the long run, we see that Paul Volcker's policy worked extremely effectively. Inflation was back down to like 5% by the end of the decade. And we haven't had super high inflation since then. Another example was in the financial crisis, when the Federal Reserve responded with very accommodative monetary policy, so literally the exact opposite of what Volcker did. In this case, it was extremely unpopular. People were very upset. You guys were probably too young for this, but to remember everyone bitching about quantitative easing and freaking out that meant that it was the end of the world because the Fed had to do different policy, which meant that they were out of their tools and, I don't know, people would be crying in the streets. Something. It was extremely unpopular. In fact, but it turns out that the Federal Reserve was not accommodative enough in that time. Had they actually been more accommodative, we should have seen a better recovery. If you look at the what's called the Taylor Rule, John Taylor from University of Stanford came up with this idea, very simple rule, where the federal funds rate should be a function of GDP and inflation. Use that to determine what the federal funds rate should be. That's a very simple rule. Greenspan basically based a lot of his policy off of what the Taylor Rule suggested. It was like kind of a guide to go off of for him, and it's considered fairly standard if you want to examine how accommodative or how contractionary the Fed policy is. Compare what the actual federal funds rate is to what the Taylor Rule suggests the federal funds rate to be. The federal funds rate, or the Taylor Rule suggested that the federal funds rate should have been negative for like 2 years after the financial crisis. While obviously negative interest rates are extremely difficult to implement in practice because people can hold currency instead. So if you've got negative interest rates in like a savings account, you would just take your money out of the savings account and hold it in cash. It does suggest that the Fed had more room to ease. And when we get into the Federal Reserve's response to the financial crisis, you can see how they actually weren't super accommodative, even though they pushed interest rates down all the way. But had they been more willing to be more accommodative, we might have, very likely we'd have seen a faster recovery. So then the case against independence is that it's undemocratic. It goes against our basic American values of having a say in how we're governed. In this case, we literally don't. Just some random academics get put on a board and they sit down and decide what's going to happen to the economy. It's unaccountable. If they do a poor job, we can't remove them from office. Because in theory, the president could remove the Fed chair if they were doing a poor job, but that's not something that we see. Yeah, there's no way for people to vote them out. Although that's also considered one of the cases for independence, is that they're not subject to short-term pressures. Pretty easy to imagine people arguing for lower interest rates than is, I don't know, required by the current economic conditions, because people want to see low unemployment. They want to see it get down to zero. Because not too many people know and understand about the concept of the natural rate of unemployment. Because most people aren't economists. So not their job to know that. It's also difficult to coordinate fiscal and monetary policy. So fiscal policy is partially determined by Congress, a little bit determined by the president. Some of it is just automatic. So say like unemployment insurance, that spending is going to go up if there's higher unemployment, because it automatically gets extended to people who are unemployed. So there's times where you have contractionary fiscal policy, you have what they call austerity, a decrease of government spending during a time of, like during a recession, when your basic Keynesian theory says to increase government spending in order to help stabilize GDP and provide relief to unemployed people, to keep businesses running, that kind of stuff. It's easy, and it happens sometimes where fiscal policy is contractionary and monetary policy is expansionary, so they're working against each other. Right now, we're seeing basically the opposite with tariffs. That's increasing tariffs is a contractionary policy, but currently the Federal Reserve is cutting interest rates. So these are literally going head to head with each other. There's also the argument that the Fed has not used its independence successfully, which a lot of macroeconomists would argue that the Fed has done a very poor job in the past. Stagflation in the 70s being one thing. Every economist in the world said it was impossible to have high unemployment and high inflation, but we did it. Not really a good time to prove people wrong. They raised interest rates right before the stock market crash in the Great Depression, helping pop that bubble, so to speak. Then in like the early 30s, when we saw like a double dip, there was like a weak recovery for a while, and then another like crash in GDP. The Federal Reserve tightened policy, increased interest rates, and helped cause that. They called Greenspan the maestro because he successfully implemented countercyclical policy for the first time. So that should, everyone flipped out and loved it and like honored him because he did his job correctly once. But think about it, just shows the bad track record that the Fed has had. And don't take this as me saying I could do it better, I'm so much smarter than them. That's just, hindsight's 20/20, and we could see afterwards that there was several times that they should have done a better job. They could have done a better job. Okay. So to explain central bank behavior, there's two main views of how bureaucracies operate. The first is the public interest view, and this dominated the theories of government up until the 1960s. The basic view is that bureaucracies serve the public interest. They try to optimize society's well-being. And that's the only thing that goes into their mind when trying to reach decisions on whatever policy to implement. On the other hand, some economists have developed a theory, beginning in the 1960s, of bureaucratic behavior that suggests that other factors influence how bureaucracies operate. And this is called public choice theory. The basic idea is that you're going to use the tools of economics to study how government works, because if I'm going to be like a rational consumer trying to maximize my utility in the market, try to make myself myself personally as best off as I can. I'm not going to just stop doing that the second I walk into my office in DC and go to work. As a government employee, I'm still going to have my own self-interest, try to do what's best for me. So both of these theories can be useful to try to predict what motivates the Fed and to see what goes into the way they design their policies. So they call it bureaucratic behavior in this slide, but for public choice theory, one of the things that that bureaucracies do is try to maximize their own welfare, which is related to their power and their prestige. So obviously, the Fed remaining autonomous, remaining independent, that's going to be huge for them because it allows them to do more. Another thing that this suggests is they'll avoid conflict with more powerful groups. So they're not going to try to take on Congress or the president head to head. And you don't see the Federal Reserve getting very involved in politics. Janet Yellen used to get asked all the time about what the national debt meant, like how bad that would be for the economy. And she said, I'm here to talk about monetary policy. You can bring in other economists that specialize in fiscal or in sovereign debt and fiscal solvency. Have them talk to you about that. So they don't weigh in on political issues in order to help keep their independence. They're going to have incentives to be more active in policy rather than sitting and waiting. They'll have more prestige, more power, and more of an effect if they actually act to do something. Also, all of us want to keep our job, right? Once you're out there working, you don't plan on getting fired. You want to get promotions to make more money. So that's another reason that bureaucracies tend to be more active. If you can show that you did something, you designed a regulation, you implemented it, and now you're making sure people adhere to it, you're actually doing something. That's something you can demonstrate to show you're doing a good job to get yourself promoted down the line. And this isn't like a conspiracy theory saying that bureaucracies are evil. It's just like these are the incentives that they have. But likewise, public choice theory doesn't rule out altruism. If you're going to go into government, usually it involves a pay cut. You don't make as much. You have a great work-life balance and insane benefits, but your salary is not super high. You do have this implicit desire to do what's best for the country or the state, depending on what level of government you're working for. So that's definitely going to enter your mind as you're helping design policy. So really, it's some combination of the two. It's not evil robots just trying to do what's best for them, country be damned. But they are going to have incentives to make themselves more powerful, to do more, to get promoted. One of the examples of this is the interest rate on excess reserves. The Federal Reserve has lobbied successfully Congress to pass a law in 2006, so right before the financial crisis, enabling them to pay interest rates on excess reserves that banks hold above whatever the reserve requirement is. They argued that it was necessary to have this potential policy tool in case of some economic downturn, which came up, within a year after getting this power. One of the reasons going into this, of many reasons, is that one of the jobs of the Federal Reserve, of the local, like the 12 regional banks, is serving as a clearinghouse for checks. This used to take a lot of people to do because a lot of people pay with checks. But now that a lot of people use credit cards and debit cards, checks are used far less frequently than before. So they have all these people who used to help clear checks between banks that aren't necessary anymore. So paying interest rate on excess reserves to banks is a way for them to be able to keep all those people employed. At the same time, it's also a policy tool for the Federal Reserve to use, just a different one. And it's at this point, it's basically their main policy tool because no one uses the federal funds market.
What about clearing things? Why did they do with now the clearinghouse kind of is clearing
What do you mean?
stuff?
Like,
clearinghouse,
Yeah.
most of they're like, are they quasi-government? They're not fully government run.
what do you mean?
Like the clearing payments you're talking
Yeah, that's something the Fed does. So it's
about. They also do that?
yeah, they're like how banks like clear checks between like a check written on one bank that gets deposited in another bank will go through the Federal Reserve. It's just a lot more rare
Okay.
because I'll just Venmo people instead of writing them a check. But that was when checks were huge. That was like one of their main functions. Before the Federal Reserve, they would have private like clearing institutions that were clearinghouses for checks.
Like the clearing.
Yeah, so like the Suffolk Reserve System, Suffolk system, I forget. Like in New England, was like a clearinghouse for like 6-7 states for all the banks there. It was privately run. It was really effective.
Was
Yeah. I mean, being in clearinghouse for checks, it doesn't require the government to do that. Like the free market can handle that. No one in the free market besides J.P. Morgan can do monetary policy.
I was in DC.
The joke about that for you guys that weren't in class, because in the library, I don't have access to the O drive to upload the videos from class. So I have to remember to do that after I leave class today, while I'm still in the building. But in the panic of 1907, there was no lender of last resort, obviously, before the Federal Reserve. But interbank lending had ceased. There were so many insolvent banks that J.P. Morgan himself acted as lender of last resort, loaning to all these the banks that were illiquid but were still solvent. They just didn't have it like the cash on hand. They couldn't sell their assets in time to like settle everything. So they borrowed from J.P. Morgan himself to lend out. That's why I said only he can be lender of last resort. Okay, so the Fed's communication strategy has changed dramatically throughout the years. They really didn't have any communication strategy early on. They just told banks what their new reserve requirement was. But over time, more and more people have paid attention to the Federal Reserve. They now have to testify before Congress. So their strategy has changed dramatically over the years. Starting with really Ben Bernanke, they became much more transparent to the public, so people were able to actually see what was going on and know what was going on much more than they had before. So after 4 FOMC meetings, the Federal Reserve Chair holds a press conference to clarify the minutes, basically, from the Federal Reserve meetings, to explain to the public what the new policy is and what went into reaching that decision. So they'll talk about GDP growth, or maybe the output gap was too high this quarter as opposed to last quarter. Maybe different government policies. There's contractionary fiscal policy. They may have to take a more accommodative stance. Just go through all different explanations so people understand what's going on. Along with this greater transparency of how they reach the decisions and what decisions they've reached, since beginning with the Fed's response to the financial crisis, I don't remember what year they started. They did immediately or down the road a little bit. They began communicating a specific target for the inflation rate. It's always been, since they started inflation rate targeting, it's been up 2% pretty much, but they didn't come out and say it for a long time. They just said, price stability. But it's been 2% since like 08, 09, somewhere in there. They pretty much missed that target almost every single month. There's been a couple times they were right at about 2%, but they've consistently undershot that for almost the entirety of the recovery. Something I should note, one of the things, I guess one of the problems with the Fed's communication strategy is basically the fact that they use an inflation target. So during the financial crisis, Ben Bernanke said we want to push inflation up to 2%. That we're experiencing too low of inflation, so that's our policy goal. And some people that were listening to that, a decent number of people, got upset by that, saying like, unemployment's through the roof, and you're talking about making it more expensive for us to buy stuff. Shouldn't you be trying to lower the unemployment rate? Because inflation isn't the goal. They don't want inflation to be increasing by 2%. They want GDP growth and low unemployment. The inflation rate is just their target. So instead of coming out and saying we want to see production increase, we want to see unemployment fall, they're basically targeting the side effect of economic growth, which is how people begin to get confused and get frustrated with the Federal Reserve. One of the reasons that people may not support independence of the Federal Reserve is they see the Fed as doing something to hurt them, when in reality, they just want economic growth. And inflation is usually a side effect of that. In the past, before Bernanke, the Fed was accused of using, they call Fed speak, super opaque, confusing language done in order to mask what's really going on. Alan Greenspan was the master of this. He once made a comment to the effect of, if you think I'm being clear and you understand what I'm saying, then you're 100% wrong, because I'm trying purposely to be confusing for you guys. There were a lot of people in the financial press that like their job was to try to understand what the hell Greenspan was talking about at his press conferences and at his congressional testimonies. He did that on purpose to try to mask what the Federal Reserve is doing, so it was more of a surprise. We'll talk about this later, but the basic idea is monetary policy can be more effective if it's a surprise than if people are expecting it and already price it in before it's been announced. So that's one of the things that Greenspan was trying to do. Another thing is it gave him an out later if they had to reverse policy. It would look better if people didn't really know what he was saying or could interpret what he said either way, as opposed to the Fed the past couple of years saying we need to increase interest rates, in case we have another crisis. Next recession, we need the room to lower interest rates. And then cutting by 25 basis points 2 meetings in a row, just reversing that later. Makes it seem like they know what they're doing more, that they have helped keep that prestige. And something, I forgot to say this earlier, about the Federal Reserve independence, they tend not to be politicians or people, even really from private industry, they tend to be academics that are elected to the that are nominated to the FOMC. Greenspan was a professor who studied the Great Depression for most of his career. Volcker had time in academia. Greenspan is one of the contradictions to what I literally just said. He was in private industry for a long time. Yellen was at the San Francisco Fed as a researcher, worked all the way up to the president of the San Francisco Fed, and she was vice chair before she became chair of the Federal Reserve. Alan Blinder has been in and out of academia. He's now at Princeton. He was the vice chair of the FOMC for a while. And one of the things that this does is it helps them, they consider different ideas. They're much more open to discussion. And they're not so much concerned with like short-run performance as they are with a more longer-term view of economic stability, as opposed to someone maybe like more closely associated with politics. What happened? Okay, So now, briefly look at the European Central Bank. It was patterned after the Federal Reserve. Central banks, that used to be the central bank of each country, they now operate very similar to the regional Fed banks in the United States. Their executive board has a president, a vice president, and 4 other members serving 8-year non-renewable terms. They also have a governing council. So, decentralized, like the Federal Reserve is decentralized. For many of the same reasons that the Federal Reserve was decentralized. Diverse population, skeptical of government power. The European Union is a supranational government, so it's like overseeing like all these various nations who still want to have some independence. There's still differences between the Fed and the ECB. So national central banks control their own budgets and the budgets of the ECB. So you've got different fiscal policies that go on in each country. So you could have Germany with a very restrictive contractionary policy, and you can have Spain with expansionary fiscal policy. Monetary operations are not centralized in the ECB, and they don't supervise and regulate financial institutions like the Federal Reserve does in the U.S. The Federal Reserve is like one of like 12 federal banking regulators who each have a different slice of the financial industry. The Governing Council meets monthly in Germany. So you have all the heads of the central banks in the EU, and then 6 executive board members. They operate by consensus. Federal Reserve shoots for consensus, but that's not always the case. Last meeting, there were 3 dissents. One said cut the federal funds rate more. 2 of them said keep the same or increase it. Bernanke and Yellen like to go by consensus to help provide legitimacy, especially during the recovering from the crisis. It was important. They felt it was important to have a unified front and to show that the Federal Reserve knows what's going on and they know what they want to do. But it's not always the case. Greenspan completely overruled the rest of the FOMC before. So I guess it's just based on the different chair for the Federal Reserve. The ECB announces their target rate, and they take questions from the media, so more transparent than the Federal Reserve even. And to stay at manageable size as new countries join, the Governing Council will be on a system of rotations. So one out, another one in. Do it on a rotating basis. Like how the different Fed, like regional Fed presidents, 4 of them serve on a rotating basis at a time. That same sort of idea. How independent is the ECB? It's the most independent of the world. Just like the Fed, the members of the executive board have long terms, so they're insulated from short-term political decision-making. They also determine their own budget. Going through the appropriations process is a great way for Congress to exert pressure, for any legislature to exert pressure on a government agency. They do have less goal independence than the Federal Reserve has. The Fed has the dual mandate of stable price level and low unemployment. They have the goal of price stability. And the charter can't be changed by legislation, only by a revision of the Maastricht Treaty. So it would be a long and difficult process to get the ECB altered. Much more difficult than the Fed, or than Congress just passing another bill about the Federal Reserve. Tough game for the Steelers yesterday, huh?
Seems like it's going to be a tough season. It's great they don't have a first round pick either.
They don't.
They traded it for that safety.
Oh, yeah.
So if they get a top 5 pick, it won't go to
It's not even going to help them.
Yeah.
Wow, that's rough. I mean, he did have, what, a forced fumble and interception yesterday?
He's really good.
Yeah.
So he might be worth it overall, but like if you get like a top 3 pick and you get like 2 and 14 or something, really the way it's worth it. You know what I mean?
Yeah.
It's kind of like that.
I was shocked yesterday when the Giants somehow pulled that game out.
I'm just focused on the fantasy team.
My fantasy team's not even doing that good, so I got nothing.
I'm going
Two, because I love Tyler Lockett and Sean Watson on the bench. I put in Emmanuel Sanders who had 28 points last week and decided to score 3. Tyler Lockett decided to score 32. And then Lamar Jackson decided to only have 20 and Deshaun Watson decided to have 26. Whatever.
That's not terrible. Only 6 points.
Yeah, but I mean, 3 and 32.
Yeah, that's a big drop.
to. I got Patty Mahomes in like the 4th round in my league, and he's dropped like 20 points or more every week.
How'd you miss in the 4th round? It was
Does
fun.
no one in
It was
PPR
fun in our first round.
In PPR leagues, no one drafts him.
Yeah, QB's fall in PPR leagues.
Yeah, they really do. And I think it was like the 3rd or 4th round. I was like, he's still there. I'm taking him.
It's a point loss.
Okay. So here's some other foreign central banks. There's the Bank of Canada, which essentially controls their monetary policy. Canada didn't have a central bank until the 1930s. Their banking system, they had what we call free banking, where they had a commodity standard. So they were on the gold standard at the time. And banks issued private currency based on the gold they had in reserves. They didn't have the sorts of regulations that we had in the United States, especially unit banking laws. So banks up there could have branches like we do now, which helped them diversify their assets, and they weren't so prone to bank runs. Yeah, they didn't have banks go insolvent and fail in the Great Depression, but there was an international meeting of all the central bank leaders, and in order to get a seat at the table, the country had to have a central bank. So Canada created a central bank so they could have a seat at the table, help determine international policy. Bank of England, they have some instrument independence. They are the second oldest central bank. They were founded in 1694. Only Sweden has an older central bank. They're very bound by tradition. That was supposed to remind me to say something, and now I don't remember what. They had like virtually no independence until I want to say like 15 or 20 years ago. They were under the Chancellor of the Exchequer, I think. Yeah, I'm blanking on that, so I'll let it go. I'll just leave it there so I don't tell you guys something wrong. The Bank of Japan, back in 1998, they gained more independence from their federal government. The trend overall has been of greater independence of central banks because it's more effective for monetary policy. The Bank of Japan has been Japan itself has been going through, I don't know, they used to call it the lost decade, like back in the 90s, but I guess lost 30 years. Outright deflation or super low inflation, just a generally struggling, low performing economy, which is crazy because through the 70s and the 80s, their economy was hot, and there was concern that they'd have a higher GDP in the United States because of how strong they were growing, and we just saw it stop. Now they have a lot of demographic issues. They have the oldest population in the world. You have a ton of old people, you're not going to have great GDP growth. All these people are retired. So they have their own sort of issues. But like I said, the trend is towards general independence, which is a good thing. That's the end of the chapter. Do you guys have any questions about the structure of the Federal Reserve?
Definitely an expert now.
Now you're an expert? Okay, so it's 5 minutes early, but I'll just let you guys go. Before you leave, just know, you can pack up and shit, but